Wait, let's unpack this. The One Big Beautiful Bill Act, signed July 4th, 2025. I mean, it's the biggest federal tax overhaul we've seen since 2017. It makes some things permanent, sure, but the real surprise, some pretty significant temporary tax relief. So today, we're diving deep into two areas that could really impact you. The new no tax on tips and overtime deductions, and the changes to the SALT deduction.
Right. And what's crucial here, I think, is that while the Act stops some tax hikes, these new bits, well, they're complicated. Lots of specific rules you'll need to figure out. It's not just what changed, but, why it matters for your wallet.
Exactly. So first up, tips and overtime. The headline news, they're above-the-line deductions now, which is great, right? Because that lowers your adjusted gross income, your AGI straight away. Helps everyone itemize their standard deduction takers.
It's a good starting point.
Could even help you qualify for other AGI-based credits. But are there immediate catches, limitations we should know about?
Oh, absolutely. First big one. It's temporary, set to expire December 31st, 2028. And this is key. It only cuts your federal income tax, your Social Security and Medicare taxes, FICA. Still got to pay those in the full amount.
Okay, important distinction. So not a total tax wipeout. Now for tips specifically, there's a $25,000 annual cap. Seems simple enough. But I saw this detail. Not just any tip qualifies. It has to be voluntary, okay? And for a job that customarily and regularly receive tips before the end of 2024.
Yeah.
Treasury's even making a list. And things like non-cash gifts don't count either. That sounds, well, really specific.
It is very specific. They're trying to target it, but yeah, adds complexity. And then there's overtime. That has its own cap, like $12,500 for single filers, more for joint. But the real kicker, the nuance, it only applies to the premium portion of overtime pay.
Premium portion.
Meaning the extra bit you get paid specifically because the Federal Fair Labor Standards Act, the FLSA, requires it. So overtime, just some state law, union contract, employer policy. Nope. Not deductible under this rule.
Wow.
Yeah, that's going to be a huge headache for employers trying to track it and for employees trying to understand it.
Okay, so a lot of fine print there. And like a lot of tax benefits, I assume there are income limits, phase-outs.
You bet. Both these deductions start phasing out. For single filers, it kicks in around $150,000 of modified AGI, $300,000 for joint filers. So if you're a higher earner, you might see the benefit shrink or disappear entirely. It's definitely not universal.
Right. And a practical point for 2025 heads-up federal income tax will still be withheld on these amounts initially. You won't see the cash benefit until you file your return in early 2026, either as a bigger refund or, less tax owed.
Good point. Delayed gratification.
Okay, let's switch gears. Speaking of changes with twists, let's talk SALT-I, state and local tax deduction. Big topple for people in high-tax states, the old $10,000 cap. Temporarily boosted. We're talking $40,000 for most folks, $20,000 if you're married filing separately. That's effective 2025 through 2029. And it even adjusts for inflation.
It does. But here's where it gets, fascinating, I guess. The phase-out for this increased SALT deduction is super aggressive. It starts at $500,000 AMGI for joint filers. And listen to this. The deduction gets reduced by 30 cents for every dollar you earn over that $500K.
30%. Wow, that's steep.
Yeah. So basically, by the time your MGI hits $600,000, poof, that extra benefit is gone. You're effectively back down to the original $10,000 cap. Though importantly, there's a floor. It won't drop below $10,000. So it helps middle and upper middle incomes, but phases out fast for high earners.
Okay, so targeted relief again. But here's something huge for business owners listening. The PTEAT workaround, pass-through entity tax. It survived. Despite talk of closing it, that strategy where the business pays the state tax instead of the owner is still totally viable.
It is, and that creates a really interesting split, doesn't it?
It really does. High-income W-2 employees, they're stuck with that fast phase-out on the individual SALT cap. But business owners, they might be able to sidestep it completely using a PTT, it feels like.
Well, a pretty big planning difference depending on how you earn your income.
It's a major divergence, absolutely. Highlights a significant planning disparity baked into this new law. Different rules for different players, essentially.
So, summing this up, what does it all mean for you? Well, you've got some potentially significant but definitely temporary tax relief coming. But it comes with real complexity, those narrow definitions, the steep phase-outs.
And that clear split in treatment now between business owners and employees on the SALT side.
Yeah. So bottom line, record keeping is going to be absolutely critical.
Yeah.
Crucial. Keep those W-2s handy, especially for 2026 when they might add new boxes for this stuff. Detailed pay stubs showing that FLSA premium overtime.
Keep your own tip logs if that applies. Property tax bills, state tax payment records.
And Schedule K-1s if you're a business owner using PTTs. You need the proof for these deductions, especially if the IRS comes knocking.
Which leads us to the final thought, really. A question for you to consider. Given that these benefits are temporary and these new disparities exist, how should this deep dive change your financial planning, your record-keeping habits for the next few years? I mean, are you actually set up to track all these new, very specific details to make sure you get every dollar you're legally entitled to? Something to think about?